to everyone who has joined us from wherever you are in the world today. I'm Stephen Scott, the founder and CEO of Starling. This is the first in what we hope will be a series of webinars that we will feature with our partners at the Chartered Banker Institute on the topic of banking sector culture and conduct reform. Many of you may have seen a retrospective white paper focusing on these issues that we produced earlier this year, which was meant to commemorate the 10th anniversary of the UK Parliamentary Commission on Banking Standards, or PCBS, as we'll refer to it during today's conversation. Let me just note on the bottom of your screen, you should see a resources tab that will carry you to that report. If you haven't yet seen it, I encourage you to have a look. And I'm delighted that we have three of the contributing authors to that report joining me today for this conversation. Let me start by welcoming the Baroness Susan Kramer, who was a member of the Parliamentary Commission on Banking Standards. Also with us is Stuart Mackintosh, the Executive Director of the Group of 30, and Maria Rajmakers, who is currently a lecturer in human behavior at the VU School of Business and Economics in the Netherlands. Maria was also the head of behavioral risk management for ING, prior to which she was with the Dutch Central Bank and a pioneer in the application of behavioral sciences to supervision in the banking sector. Let me also note that we can take questions in the chat function, and I encourage you to put questions there. We will monitor for those. We'll try to have some time at the end in order to answer some of those questions. But for now, without further ado, if I may, I'll turn to Baroness Kramer with the first question. So your participation in the Parliamentary Commission, or PCBS, just to keep it simple, really gives you a unique and important perspective for this conversation. Just to maybe set some groundwork for the audience, I wonder if you could just offer a little background on what was the motivation that led to the launching of the PCBS? Why was it felt to be necessary at the time? And then on a personal note, what were your own personal goals in having become involved with that?
So you will remember that we had just been through a financial crisis that was almost global in scale. In the UK, we then followed this up with the failure, and partly in consequence of three major banks that had to be rescued by the taxpayer. The damage that resulted from both of those that undermined our national finances, greatly limited what could be put into public services. And for ordinary people, it led to years of austerity. So like others, I said, never again. We have to stop this. And it's going to be a matter of looking indeed at culture, as well as looking at regulatory frameworks, and the whole environment, holistic environment in which banks operate, and making absolutely fundamental change. So that was a great deal of my motivation, that opportunity collectively across Parliament to drive forward very fundamental change. And we did. We established individual responsibility for senior bankers. Before every excuse, everyone got off scot-free just by saying collective responsibility. So we set up ring fencing to separate the retail banks from the investment banks, who have been treating retail bank accounts as a honeypot for high-risk activity. We opened up banking far more aggressively to other kinds of competition. We empowered the regulators, who have been incredibly deferential and powerless up to that point in time. And we tried, not with a great deal of success, but to establish much more parliamentary accountability. I mean, there certainly were things that we didn't get done. We never tackled the underlying issues of duty of care and that financial services should have to individuals. I really regret that we didn't get a grip on that. And frankly, in many of the areas where our changes made progress, we're now watching that progress being gradually reversed. And we'd almost predicted it would happen. People become complacent. They'd say the banks have learnt their lesson. Oh, we can afford to have a whole lot more risk. Let's disempower regulators. And we're starting to see that happen here, which is exceedingly worrying.
Baroness Kramer, thank you very much for that. Forgive me, I should have given you an opportunity to introduce yourself to the audience beyond what remarks I made at the very beginning. Would you like to offer anything more?
Very simply, I have been an elected member of Parliament, but I'm now in the House of Lords, which is the upper chamber. I'm a member of one of the smaller parties, Liberal Democrats. But in the House of Lords, where I participate, we work very much across party and on committees, and the Parliamentary Commission on Banking Standards was a real example of that. It was completely across party lines. That operation, really fundamentally important, because in the UK, that's the only way to make long-term change.
Excellent. Thank you very much for that. And next question, if I may, I'll direct to you, Maria. And if I can ask you to come off mute and maybe say a few words to introduce yourself more fully than I've done.
Yeah, of course, Stephen, thanks. Well, I've been, as you've been saying, working on applying behavioral science in the financial industry, first as a supervisor at the Dutch Central Bank. And after 6.5 years, I joined ING Bank, where I became global head of behavioral risk management, being responsible for diagnosing culture issues, so to speak, but also responsible for how to intervene and how to change the behaviors that you want to change. And maybe to remind you, that was back in the days when ING had to settle with the Dutch government for 800 million euros around shortcomings in the anti-money laundering area. And since a year, I am an independent advisor, also a lecturer at the Free University, but also an independent advisor, and still working across industries, so beyond the financial industry, on applying behavioral science.
Let me pick up on that, Maria, and embarrass you a little bit. You're far too modest to say nice things about yourself, so I'll do it for you. As many on this call may know, you're fairly renowned for having been the first organizational psychologist to be employed by a central bank with a view to bringing learnings from behavioral science to the supervisory function, and quite literally wrote the book on how that's to be done. And many people who talk about how supervision has changed to incorporate some of these ideas point to you, your work, and the example of the DNB. But we've talked about this. The work of the DNB in many respects came about as a consequence of the Parliamentary Commission on Banking Standards and some of the questions that were raised by that commission. So I wonder, again, in keeping with history, if you could just take a little bit of a step back and give us a sense of that. What was the thinking at that time in the Netherlands? What motivated the Dutch Central Bank to create your role?
Well, the financial crisis has been an important motivator for the Dutch Central Bank to say, look, it's not just metrics and organizational structures that drive behavior and performance, but we need to zoom in more and understand better what's going on in terms of human behavior and how that impacts performance and integrity. And as you know, here in the Netherlands, we had a couple of examples of a very dominant CEO, for example, who wasn't there was no countervailing power. That was an important reason, but also the PCBS report was important. And why? Because there's I would say, very powerful examples of what kind of behavior drove, the performance and the lack of integrity that's been described in the PCBS report. So we see there's a chapter on the underlying drivers, right? The underlying causes. It says very clearly that there are deficiencies in culture and standards. We have examples in the PCBS report on people who duck their personal accountability of status differences between, front, middle, and back office. I think those examples, back in those days, we didn't have a lot of those examples. There wasn't much out there in terms of reports on these topics. And these examples, I think, are just, they make these are stories where people understand how this works, what's going on in organizations, and not just the mission statements or the policies that are in place, but really what's really happening, right, beyond those mission statements and policies. And I think that has been very powerful, the report. That has been very important for the DNB as well, because back in those days, there was still quite a lot of skepticism also, and a lot of questions around do you really need culture? Is it that important? You know, do you need to address it as a supervisor? So that's absolutely something that I remember around the importance of this report.
That's great. And it's a perfect segue. For the benefit of the audience, let me just offer, there's been a sea change in the way these conversations take place globally around the culture in the industry. Is that a thing that we should be concerned about at all? If so, why? Whose job is it? What does culture mean? Is that very soft and fluffy? Is it something that really lends itself to supervisory activity? Can it be operationalized? And there are three seminal pieces of work in my mind that really set the stage for the conversation as it has unfolded over the last decade. The first would be the Parliamentary Commission report on changing banking for good, which was addressed to a broad audience, but really sort of called the attention of policymakers to some of these issues. Maria, the work that you did at the DNB really set the stage for how supervisors think about this. And then Stuart Mackintosh, as the director of the Group of 30, produced a 2018 report on these very same issues that was far more focused at the industry itself, at leaders in the industry, and getting them to think about these questions in a management context. So, Stuart, with that, let me pause and let you introduce yourself, if I may, and then put the next question to you.
Thank you very much, Stephen, and thank you for creating this forum. Thank you to the Chartered Bankers Institute as well, and to Simon Thompson for his very good work in this space and many other places. I would want to salute, of course, Susan for her incredibly important work, and also Maria for your trailblazing work on behavioral pieces. I run the Group of 30, and as you say, we had more than a decade of focus on culture, conduct, the role of the board, the role of senior managers, the role of supervisors. We intervened very early after the global financial crisis with the Volcker report. It's going back into that period when we promulgated the Volcker rule, which is the prohibition of proprietary trading for large commercial banks. We weren't very popular for that, but that's an instance of our intervention there. But then we, as you rightly said, Stephen, refocused on the issues of how do we get corporate C-suite level and boards focusing on the conduct and culture issues that are damaging our banks and damaging the banking sector.
And if I can draw you out a bit further on that, in the comments that you offered in our retrospective piece, Stuart, you spent a fair bit of time comparing and contrasting the work on these issues that's been done in the UK and in the EU, and comparing that, I would say, somewhat disfavorably with what's taken place or has not in the US. Can I ask you to just expand upon that a little bit, and what do you think we should be thinking about in this country?
Well, I would say that we failed in the US to grasp the regulatory nettle, the supervisory and regulatory nettle immediately post GFC. We didn't put regulatory structures in place like those seen in the UK, the senior managers regime, forcing responsibility on the shoulders of people who are actually taking outsized risks and endangering their firms and the economy and so on and so forth. In America, it's perhaps not surprising, but in America, people were quite leery of doing that. So what we ended up with was less supervisory regulatory rigor and more exaltation. So the G30 was in essence focusing on the C-suites, focusing on the boards, and trying to exhort them to make the right changes, to recognize the importance of culture and conduct, absent the regulatory rigor. Now, there are some regulators in America who've taken, and supervisors who've taken big steps, most notably the New York Fed. They tried, they continue to push the issue under John Williams, and I commend them for that. But if you ask me whether the Federal Reserve Board, and up until recently the OCC, really focus on conduct and culture, not so much. And that's been a sad missing piece in the US response to the cultural failures that continue to this day, as you know, Stephen.
That's great, Stuart. Thank you for that. And with that, I wonder if I can turn attention back to you, Baroness Kramer. The comments that Stuart offered, both in his retrospective piece and just now, suggests that the U.S. can look to the U.K. for lessons on how we ought to be thinking about some of these things. But from your own perspective there in the United Kingdom, after 10 years, have we done enough? Where are we falling short? Why do you suppose that is? What more could be done, should be done?
Well, thank you. I should have said in introducing myself, I was a banker by trade, so I came from some inside background, if you like, in addressing these issues, and have been warning about some of them for a period of time. We made some really significant steps forward. It's not easy in the UK system to introduce change. There tends to be all of the resistance that you see anywhere else, and I would say plus this sort of, the reverence for tradition and for the idea of gentlemen's handshakes and integrity amongst leading persons, etc. So a lot of it was a case of trying to roll a stone uphill. We took evidence for nearly 2 years. And I think, frankly, it was having some of those senior managers in front of the committee being grilled with questions, for a couple of hours, and then another one coming the next day and going through the same process, that in a way began to show that the emperor had no clothes. And that gave us, I think, the real opportunity to make change. But it hasn't all been successful. I agree with others that one of the most important things that we could have done was pin down this issue of individual responsibility. But we haven't done it that successfully. The regulators have allowed it to become rather a box-ticking exercise. And at the moment, the current government is talking about future reforms, which will water that down farther and move us back towards the idea of collective responsibility. And that would be really seriously undermining. It should be strengthened right now and not weakened. But, the same thing in a sense with the ring fencing. It's clear that a lot of the sort of cultural misbehavior, because of the extraordinary temptation of what felt like free money sitting in retail bank accounts, that you could go and kind of roll on the equivalent of the casino, reap the rewards and never have to deal with any of the losses. And that separation was really important. But that's now going to be reviewed again under what are called the Edinburgh reforms. And we saw a breakdown of it in the arrangements that were made for HSBC to come and rescue Silicon Valley Bank UK. It's an agreement that essentially gave them a path to avoid ring fencing. And the other banks were all going, wait a minute, give them that, give us that. So we've got those kinds of problems. So there's be careful what you learn from us would be my answer. And look at some of the success that we've had, but also look at the places where the system hasn't been powerful enough and hasn't been strong enough. I think one of the areas where the US tends to be ahead of us, at least from our perspective, is that your regulators are less deferential. And there is a tradition of deference here in the UK, a real fear of even interviewing senior managers. And therefore always looking for paper trails. I mean, what idiot's going to leave a paper trail when they've gone and told someone to distort LIBOR so that will boost some bonuses and bank profitability? So there are lessons to learn, but don't be slavish to us would be my answer. And we need to be very careful we don't start to slide back out of general complacency.
Thank you for that. And if I may, Stuart, I want to come back to you and pick up on something that Susan just shared. She talked a little bit about holding feet to the fire, specific individuals. I asked you earlier about views from the US, but of course the G30 is a global body and you work with people across the industry and across the globe. In Australia, we saw some years ago the Hayne Commission, similar to a parliamentary inquiry, that was holding not just the bankers' feet to the fire, but also the regulators' feet to the fire. We haven't seen quite the same thing here in the US. But let me just ask you to think a little bit about what we're seeing in C-suites. So we hear policymakers talking about these issues. We hear supervisors talking about these issues. Industry bodies such as yours have talked about these issues. Is this something that's really talked about in C-suites? Do bank executives, in your view, give this much time and attention? Or is it more of an afterthought? It's people stuff, so we sort of hive it off to HR and let them run a survey? Or What's the real sort of reaction to this in industry in your experience?
I guess I would start by saying, well, of course, it depends. On the one hand, if you've got a well-functioning C-suite, a assertive board that are asking the right questions, that have a dashboard of data, can see when whistleblowing is going on, can see through to what's motivating the staff through surveys and through other metrics, some of which you've designed, I know, Stephen, yourself, then you have some surety, and supervisors may also have some surety that, well, people are taking it seriously. And oh, look over here, the board has a committee that oversees these issues and discusses it on a regular basis in that committee and then at the board. And the C-suite is occupied by individuals who embody the culture, embed it, align the firm, and repeat the lessons day in and day out. Because this is, as you know, not something that we do one day and then set aside and carry on with business the next. So when you're that type of firm, yes, I see real change. I've seen the change. I can see it. I can feel it. You can almost feel it when you go into those firms. And you go to another firm and they've got culture and conduct. They did one day 5 years ago, where they talked about it, and all the first line people said, oh, well, that's really boring. Why were we doing that? And then the thing is left in HR to die a slow death. Well, those firms risk material damage to their business. And the problem in America is that we tend to talk about it as all firms being somehow separate, unique, and completely different, and therefore there aren't lessons for everyone to learn. So when Wells Fargo blew up over the terrible scandals around that, you saw Wells Fargo leadership saying, oh, it wasn't my fault, nothing to do with me. There wasn't a full reckoning with the cultural failure. And I think that's the struggle. The firms that are good at it and that are led by charismatic, committed individuals who understand the nature of the beast, they do it well. And then the other firms may be hubristic and they think that they got it right because they're making lots of money, and suddenly, boom, the whole thing blows up. Because oftentimes, as we all know, when you're making outsized amounts of money compared to your other competitors, it may be that you're a genius, but it may more likely be that your subcultures are engaged in bad behavior. So it depends, I would say.
Thanks for that. Maria, let me bring this back to you, if I may. So other than keeping policymakers focused on this issue, keeping bank executives focused on these issues in their own enlightened self-interest, one of the things that's cropped up in just the last couple of years, as I'm sure you've seen, is that many of the regulators and supervisors who have focused on these issues and who have sort of held the industry to account or sought to hold the industry to account have suffered from their own cultural issues. We actually have a report coming out in the not distant future that we're entitling Physician, Heal Thyself. There's been a lot of attention in a lot of different markets around the world to the regulatory bodies and the cultures within those bodies, and whether or not those cultures are supporting them adequately in fulfilling the function that society expects for them. Stuart was right to call out the great work that the New York Fed has done in convening a conversation around these issues for the past several years. At their most recent conference, they had the vice chair for supervision from the Fed, Michael Barr, who commented, Maria, directly on the work that you had done at the DNB and said, look, we've seen that regulators and peer institutions in other countries have used new tools. We might want to consider applying some of those tools in our own look at ourselves. So let me just ask you, if a supervisory body were to try to put some of these ideas to work within their own organization, how would you advise them to get started with that? What would they want to look for in order to assure themselves that their own culture is serving their purpose?
Well, I think there's two important angles to answer this question, right? There's on an operational level, so to speak, right? There's the tools and the methods and to make sure you have, you gather the right data, and I'll get back to that. But I think what's really crucial as well is on a more strategic level that, regulators are, fully aware of the fact that you need to understand the beast, as Stuart is saying, right? And therefore you need to bring in capability that is able to do that. And you need to make sure that this capability also has a mandate to really have the position to go to the industry as a regulator and find out, what the beast looks like and what the trouble areas are. So if I look back at the days at DNB, but also when I moved to ING, it has been always very important to me that, the positioning of where you do your job, so to speak, is strategically well positioned, right? You're able to have direct lines within your supervisory agency to report on the issues that you see. And you also have very direct lines to, senior managers in the industry. So as Baroness Kramer was also saying, right, that people find it hard to interview senior managers. I think if you bring in behavioral science, people with a behavioral scientific background, this is exactly the kind of capability that you bring in. They are able to talk to senior managers about behavior and culture, which is usually a very sensitive topic to discuss because it's up close and personal, but you need to bring in capabilities, people who are able to have these uncomfortable and sometimes very challenging conversations. And so it means on a strategic level, and I think the DNB was very brave to decide we need a different type of capability in our organization. We need different kind. So I think on a strategic level, that's absolutely something that you need to decide. And my concern, if I look at the industry, but also the regulators, we do bring in those capabilities, but we position them too low in the organization, right? Where they are not part of having a direct line to the C-suite, but also being a peer to the direct reports of the C-suite, which is also incredibly important. And so that strategic positioning is very important. And on an operational level, you have to make sure that you are able to collect the data that will give you information on, what is it that people really do, right? It doesn't, you need to stay away from the tick the box exercises, obviously, to find out what the culture is like, right? If you compare it to an iceberg, you need to dive underneath the waterline to find out what's going on. And again, you need to have the right capability, but you need to have the right tools. There's a lot out there. Starling obviously also has tools in that regard in order to be able to scale. But it's crucial that you get data and information that goes beyond the processes and the metrics and all the the numeric data that we have on organizations.
Great. So Maria, you've used a term that Susan used earlier. So Susan, if I can bring it back to you, you talked about tick box exercises. Let me be purposefully, or attempt at least to be somewhat provocative. We see in the US and the UK and in most countries, after there's been some major banking scandal that calls the public's attention negatively, there's a flurry of activity in the legislature. And there's a sudden sense of we must do something and we must be seen to have done something. It's not always as well thought out as we might like because there's decision making under a sense of public scrutiny and public pressure. So let's hold the legislature's feet to the fire a little bit. Can't we get more proactive about these issues? It's not like this stuff is novel. When we see these different events, it has this Groundhog Day sort of feeling to it, right? We've seen this movie before. Why is it that we can't be more proactive, or are we being more proactive in legislatures and the public's just not aware of that?
Well, I can't speak for other countries, but we certainly are not being more proactive at legislator level in the UK. In fact, it's gone in the opposite direction. And I think for many of us, and again, this is completely cross-party, so it's not one political group versus another political group. This is across the spectrum. There is certainly, not at government level, but below government level, as backbenchers, there is a huge amount of concern. We had the disruptive effects of Brexit, which of course required a readjustment in the whole regulatory framework, because a large part of it had been based in Europe, where I think, to Europe's credit, because it involved 28 countries, it was in fact a very much more open process than you would have seen, with more challenge, more description, more response, more intervention, more participation in creating the whole regulatory environment. So when that transferred to the UK, all of that has disappeared. And we have very limited parliamentary accountability, or accountability to Parliament now. Now, I think there's quite a group of us that are trying to say this is a huge deficit. In fact, even the government would say, yes, there's a deficit, but the government will take the view it's not up to us to fix it. Parliament's got to find a way to fix it. And there are proposals coming forward for new committees to carry on a sort of ongoing process of keeping an eye on this entire sector, because it's one of those sectors, certainly in the UK, where if something goes wrong, the whole economy is at risk. So this is not a marginal set of issues. I think the Australians have made some real strides in this direction in terms of having an oversight committee over the regulators, and then, as it were, through the regulators through to the industry. And we are absolutely lacking that. I wanted to also pick up the issue on culture, because perhaps I haven't stressed it enough, but throughout our report, we use this phrase tone from the top. And I think we must never let go of that responsibility of those most senior people, that because the tone that they set, regardless of what the regulation is and regardless of what the detailed organizational issues are, that tone is so influential over what happens inside their organizations. And I want to therefore see that those individuals are regularly being held to account for their tone. And I see no mechanism in the UK that makes that possible. Certainly not, it's not possible at parliamentary level, and it certainly doesn't happen at regulator level either. And I think that's very worrying.
Brilliant. Stuart, let me bring this back to you at this point, if I may. One of the things that's come out in this conversation already, and it tends to be the case in most conversations around these issues, is you get a little bit of this dynamic. The regulators point to the supervisors point to the legislatures point to the C-suite, and there's an effort among all these different constituencies to hold one another accountable for different perceived failings. But surely the answer is a joined up answer. There needs to be a place, in my own opinion, where we can have an effective public-private partnership, where there is a productive dialogue that involves technologists, academics, policymakers, regulators, and industry executives. The G30 is a unique body. Maybe you can say a little bit about the organization and describe it, but let me ask you to comment on that. Is there a space for a real public-private mutually collaborative engagement around deciding what good looks like in this context, rather than people calling each other out for having failed to do what they ought to have done?
Yeah, I definitely think there is. I mean, and that's what we were trying to do in our multiple reports in this space, which is to say, you know, we're not in one camp or another. Let's look at the problem. Let's recognize it as significant material to the health of the financial firms themselves and to the system and the economy and their social contract to operate. What can we do together? What can supervisors do to oversee, as Maria so carefully and effectively did, the behavioral aspects and other aspects of supervision? What can we do from a regulatory standpoint, as Susan has done so effectively in terms of creating pressures and responsibilities? But what can also the private sector do? What can good leaders do to ensure that their firms continue to perform well, and what can other firms that are perhaps lagging pull up their socks and perform better. But if I may just lean slightly towards what others have said, I do think it's particularly upsetting from a regulatory perspective to see this backsliding that Susan talked about. And it's not, of course, just in the UK. Bankers in America have incredibly short memories. The SVB collapse, of course, shook many markets, not least the American market, even though this was a relatively small bank. For those who are on the call, they may not know that one of the members of the board of SVB was Barney Frank, whose name is attached to the Dodd-Frank bill. On that board, he argued for the watering down of his seminal piece of legislation successfully. And as a result of that, SVB was able to train wreck its company and lose money and shake the system. So we all suffer from that. But I do think the solutions have to be the connection of both, because supervisors cannot see it down into the very depths of a firm that has hundreds of thousands of people working for it across the world. It's just not possible. The people that can do that to a better extent are the first, second, and third line managers and C-suite that are in the firm, that personify that firm's culture and conduct, and that when they get it right, the firm is prosperous. When they get it wrong, the firm can train wreck and cause a disaster for all of us. So the solutions are, as you say, a nexus of those two things, of all of the people coming together and talking in a dialogue. Now, some smaller jurisdictions do it better, actually. You know, when you have a massive market, huge firms, incredible difficulty to see through the clouds. Some medium-sized markets, perhaps Canada, some small markets like Singapore, you see that dialogue between supervisors and banks and investors and so on, so that you end up with better outcomes. Will we get better outcomes in America? Given the fact that we have a Congress that has no leadership, I don't think we're going to get middle of the road sensible outcomes on banking reform anytime soon here.
On that cheerful note, let me just pause before bringing it back to you, Maria, and just note that we do have an open chat for people who would like to pose questions. I'll note two that have come through. One of our participants has asked about resources on culture risk, behavioral risk management in banking sector. Where can they find information about that? There's a resources tab, or there should be a resources tab at the bottom of your screen that you might want to look at for some of that. And we can also distribute subsequently, if you haven't looked at Starling Insights, which is a peer knowledge exchange platform that we maintain. There's quite a lot of resources there that are available, and we can perhaps circulate a link to that material after this conversation. And another question from the audience that I'd call out, and I'm doing so specifically in hopes of encouraging other questioners to put their questions in the chat, is asking about challenger banks and what we ought to expect to see from challenger banks over the next 10 years, particularly those having been launched after the financial crisis. Maria, if I can hold on you for just 1 second and put this question to you, Susan, particularly because I note that in the UK, there is a largely successful challenger bank, Revolut, with I believe some 30 million customers, that's still struggling to get a UK banking license. Maybe you can offer some sense on how challenger banks are viewed specifically in the context of these culture and conduct questions. These organizations are not necessarily free from those issues themselves. So what lessons might we take from the traditional banking sector and our experience with these issues in the traditional banking sector? What can we bring over to the challenger banking sector? What lessons might they want to attend to?
Well, traditionally, the regulators, and more specifically the Bank of England, which is the relevant one, that used to regard anybody who wanted to set up a new bank as a dangerous dynamite to be destroyed at birth. The whole experience that we went through with the financial crisis and what followed and the report changed that perspective very dramatically. I mean, individuals actually changed their position very dramatically. and decided we had to open up we're dominated by then 5 high street banks, that this had to be opened up to real competition, because how could they treat their customers so badly if people could easily pick up and go somewhere else? So that was the thinking. There has been a very big improvement, but a lot of our challenges also came from the direction of fintech. Brilliant, and again, small, different, daring. There was a lot of, if we regulate those, will we crush them? And finally, the fintechs came together and said, look, we can't afford to let rogue players into our industry, because if they do, you'll shut us all down. So let's get appropriate regulation. So we gradually moved into that space. I do think for smaller institutions, you can have a different approach to the regulatory framework, because if you've genuinely got an institution that is not a systemic risk, then you can treat it differently, for example, in terms of what it has to reserve against loans, et cetera, but I'm not sure you can treat it culturally differently. And I'm not sure that, I think that's a lesson that hopefully we've learned, but I'm not quite sure, because it seems to me people find culture so difficult to deal with that it's been easy to let that issue go and not to talk about it and press on it. But I think culturally, you have to hold the same expectations toned from the top. This is why I very much have wanted to see a duty of care for all financial services in the UK, because that then covers the entire field and says you have a responsibility to your clients. And it's not just a box ticking one. It's definitely been a plus. It's definitely a discipline. The large banks are very aware that others can cherry pick a lot of their good business. But I don't think it's been the dramatic change. I don't think it has itself led to a dramatic change in culture, at least not yet.
Great, thank you for that. Maria, that turns us to the question that I wanted to put to you, and to call attention again to innovation and technology. And we have another question in from our participants who references a piece that I know you're familiar with, your former colleague Frank Elderson, now at the European Central Bank, recently gave a speech in which he emphasized the importance of supervising behavior and culture. And he noted that the ECB is intending to issue towards the end of next year guidance on how they believe these sort of culture and conduct risk related questions should be successfully governed and perhaps supervised. But the ECB in particular has really emphasized the application of supervisory technologies to this problem set. So the question in from the audience echoes the question I wanted to put to you, which is, what do you think we're going to see going forward from the ECB and elsewhere with the rapid evolution of AI capabilities and other supervisory technologies in this digital era, as people like to use that term? How do you think that does it transform our ability to grapple with these issues more successfully?
Well, I hope, I have very high expectations in that regard, especially from supervisors, as I think, there's a unique opportunity, right? So I think the big challenge for supervisors who want to understand where their, the weak areas are in the industry, right? What are the institutions that we really need to focus on if we talk about behavior and culture? And the big challenge, and this is also the big challenge for the large financial institutions who operate in multiple countries and jurisdictions. You need to have oversight and an overview on where are my hotspots, where are my weak areas. And I think technology has this tremendous opportunity to be able to get this overview and to scale insights on behavior, which is, back in the days at DNB, the work that we did was, I think, we went really deep into getting information on what it is that people actually do, really do. So beyond the policies, as I said, and the mission statements. And we went in like surgeons, so to speak. But the challenge is, of course, how can you scale something like that? How can you make sure that the insights that you get on what people actually do and why they do that is scalable? And technology gives us that opportunity, right? It gives us the opportunity to get real-time information on what people actually do. So again, right, I think there's a huge opportunity. I expect regulators and supervisors to embrace these kind of technologies and use it to experiment, of course, and do proof of concept and what it is you need. But I have high expectations that this is absolutely something that will be embraced and will be applied. And I would say you would be a fool if you wouldn't, because as I said, the opportunity to scale and to get real-time insights on behavior, I think, is what supervisors need to do.
Thanks for that, Maria. There's another question that's just come in from our participants, and I'll address this one, if I may, Stuart, to both you and to Susan, because it's asking about the U.S. and about the U.K., noting that we have elections in both countries coming up in 2024. And the question asks about these banking culture and conduct issues in the context of policy agendas and reform agendas. Are these issues that are likely to play a part in the election campaigns in either country, or are they afterthoughts? Is it something that we would expect to see as a part of the public discourse? And I'll just note, particularly here in the UK, Stuart, and we'll start with you on this. There's a lot of fervor at the moment around recommendations that banks hold a lot more capital in reserve. So certainly that is likely to be a topic in this country. But what do we expect to see in an election year around these issues? Stuart, if you want to launch us off.
I don't think it's going to be a central issue. I do think it's an underlying sort of tone, which is people are still angry about what happened in the GFC. They saw bankers train wreck the economy. They saw bankers in America in particular get away scot-free. No one went to prison. Most people who sold complex securities got 100 cents on the dollar. So there's still anger about that for sure. And that has driven aspects of American politics, arguably. I don't think it's going to be front and center. I do think it's important, though, of course, not to let up, as Susan has said, because now, 15 years on, memories are fading. The supervisors who are actually actively involved in stopping the crisis then are mostly retired now. And as one of my colleagues who used to sit on the trading desk of a major bank, in fact, Wells Fargo, remarked to me, the people that he saw around the trading desks, the young people, they were children then. So they have no historic memory of what train wrecked the economy, or indeed what caused the disaster in their own firm, 7 or 8 years ago. And so the role of C-suites remains crucial, even if this isn't a front and center argument that's going on in the debates around the elections. The crucial nature of the training, the technology that Maria talks about, and then the storytelling that leaders in banks have to do in order to make culture and conduct matter, is to basically explain why these things consistently matter day in and day out, to recount instances of gray areas where there's crisis and where the firm nearly train wrecked and so on. So while I don't think it's like front and center in the economic and political debates in America, which are much more fraught than focusing on bank capital, I do think it remains very, very important not to forget the lessons that we learned, one hopes, in the GFC, and to keep pushing that technological solution, pushing the supervisory solution, and also telling the stories that help our employees understand why it has to remain a central part of running good businesses.
And Susan, to close that out, I'll bring it to you. You've made reference to the Edinburgh reforms and policy debates around the role of a supervisor as creating a more welcoming economy versus one that is perhaps too heavy-handed in regulation. And I'll just offer an anecdote. I was in London just a week ago and met with a senior leader at one of the largest banks in the world, who's responsible for addressing some of these issues at that particular institution. And the comment that was made really stuck with me. It was that very often we look at these culture and conduct efforts within organizations as remedial efforts. And when the regulator has got a gun to our head, we must do something to show that we can remediate these issues. And that as soon as that regulatory pressure is lifted, this just fades off the radar screen for a lot of people. And the view that was put forward by this person was that shouldn't be the way we think about it. Rather, we should be thinking about how we look at these issues as an opportunity to achieve competitive advantage. So maybe there is a way of squaring the circle in bringing greater governance and supervision around these issues and coupling it with greater competitiveness. But with that as a little bit of color, I wonder if you'd offer us a view as to what you expect to see happening in the coming year in the UK.
Well, I mean, both you and Stuart, I think, are so right. There is often this perception that if you're going to be really competitive, then you don't want rules. And culture is for soft people, not for the really macho, aggressive revenue generators. So I don't think that's gone. The individual you spoke to gives me a moment of hope. I hope that somebody who's very senior, and I hope they're strong enough to be able to battle those issues through their own organization, because frankly, example would be exceedingly useful right now. And I'm not sure that when I look around, I particularly notice example. In terms of the election, I think there's been a fundamental impact, which is to make society and our public far more cynical. I think all of those failures, in a sense, have undermined the quality, frankly, of a lot of our political discourse as well. So that I think may turn out to be one of its most lasting, one of the greatest pieces of damage. In terms of the narrowness of manifestos, I mean, in this day of social media, manifestos are basically going to be reduced to 5 lines and all the rest is fluff. And I don't think these issues are going to get into the 5 lines because there's so many other things like cost of living that are absolutely at the forefront of people's daily existence. And that's where the focus will be. I am rather concerned that a well-funded, well-organized, very smart industry like the financial services industry sees an election as its opportunity to put limits on the change and to, we call it, you said black, they wouldn't use words like backsliding, but to refine everything. Because of course, they are now people who understand risk, they've taken culture on board, they no longer need the kind of discipline that might have been justified in the early days. They wouldn't possibly abuse an opportunity now, not the new people that they are. And I think those conversations have been going on, both with the party that's currently in government and with the party that hopes to be the government. And the financial services industry is so critical to the economy of the UK. And certainly to anybody who supported Brexit, it has somehow got to thrive despite all the pressures that are undermining it. That's as a consequence of the separation from the single market. But, I think the industry sees this timing as an opportunity to use its influence, as an opportunity to reshape the framework in its favor, as an opportunity to make sure it's engaging new friends. And I find a lot of that quite worrying. And I'm sure that Stuart is right. Many of the people who are in government today and will be in government in the future have no visceral memory of what happened that in 1907, in 2007, 2008, 2009, that they were young, they were at uni, they didn't take much notice. And the last thing they want to do is learn from old people, and I'm afraid I'm one of the old people.
Well, a pleasure to be in your cohort, Susan. Thank you very much for that. I'm afraid that that's all we have time for today. I do note that we have other questions that people would like us to address. So let me just remind that this is the first of what we anticipate as a series of webinar events that will focus on this issue. For today, let me extend my thanks to Baroness Susan Kramer, Stuart Mackintosh, Maria Rajmakers. Thank you all so much for making the time for this. Thank you so much for the very thoughtful contributions to the retrospective piece that we were pleased to put in place with our friends at the Chartered Banker Institute. Again, for those listening in, that material is available through the resources tab at the bottom, and we'll circulate something after this. I hope everyone enjoyed today's webcast. I did. I think we ended up asking more questions than we have answers for, and that to me is a sign of a productive conversation. These issues are regrettably evergreen. My big takeaway from what I heard from our panelists is we've made quite a lot of progress. So well done all, but we're not there yet. So let's not run the risk of complacency.
And thank you to you and your colleagues, Stephen, for keeping this issue alive and for giving a new generation the opportunity to understand what has happened and what can happen.
Well, someone once said the past is prologue, so we're mindful of that. And again, for those listening in, this webcast will be available to view and to share through the Chartered Banker Institute's YouTube channel shortly. We'll also circulate a link to the Starling Insights peer knowledge exchange platform that I mentioned earlier. If you enjoyed this as much as I did, please feel free to share that information around via your own social media channels. And we look forward to seeing you all again on the next episode in this series. So keep an eye out for that. And with that, let me say goodbye and offer Maria, Stuart, any last comments from you?
Well, thank you. It's been excellent to have this conversation. It's a very important conversation, and the issues are evergreen. I salute you, Stephen, for hosting it. I salute the Chartered Bankers for hosting it. I know they're doing great work in this space, and it's an absolute pleasure to meet you, Susan, and also to see you again, Maria. Keep up the good work, colleagues. It's a pleasure. Thank you so much.
Brilliant.
From my
Maria?
side, just a big thank you. And I have nothing to add to those very wise words my colleagues just said.
Excellent. Thank you all. I wish everyone a good day, good afternoon, good evening, and thanks for spending time with us. Bye for now.